All right, everyone. Q3 reports for 2025 is out for multifamily in the entire U.S. market, and this report is from Cushman and Wakefield. So thank you for creating this report. It's publicly available, so you can all take a look at exactly what this data shows and go dive into it further than this video. But I wanted to summarize what I took away from this Q3 2025 multifamily report and go over some of the data with you, because as a real estate fund manager, I like to take a look at these things and share my findings and share the data that I'm reading alongside with you. So, and it's great to understand, what your thoughts are too. So if you have any thoughts about this, any of these things, leave them in the comments. I would love to hear them. I have absolutely nothing to sell you. I'm just a managing partner at a real estate fund, real estate private equity fund, and I have absolutely nothing to sell you. Cool. All right, let's just dive right in then. As you can see here, these are the market fundamentals. And so in the US overall, vacancy rates have creeped up to 9%, and the outlook is that it's going to continue increasing. As far as the net absorption of units, it's remained at 102,600. There has been a year-over-year change in the net absorption units. However, it still has been the third straight quarter of more than 100K net movements this year. So that's at least some positive there. But the outlook seems to be that the net absorption units will go down in the future. As far as the market rents, 1900 is the average market rents that the US is seeing across the board as of Q3 2025, and they believe that it's going to continue going up, which I do agree with as well. And as far as the rent growth goes, 1.5% rent growth year over year across the entire US market, and they believe that it's going to continue to go up. As far as new under construction units, 454,000 of them are under construction. And you'll see a lot of the supply and demand differences between these markets, but we'll go dive into this a little bit further as we go down here in the deck. As far as the economic indicators, something that everyone takes a look at is non-farm employment, seeing what the year over change is. So that is higher year over year compared to 2024, which is always good. However, the outlook is negative and it's going down, and the reason for that most likely is because some of the job market reports haven't been as strong and some of the markets have been volatile. So we'll see what that's going to look like, but the sentiment seems to be that it's going to go down. And something correlated with that is the US unemployment rate. So that has ticked up year over year. 4.3% is the unemployment rate as of right now, and then the outlook is that it's going to slightly increase from there. And then you can see here this household growth is remaining at 0.8%. And some of the big things that I want to highlight are the largest year over year rent growth. So you can see here, San Francisco had a huge boom. They had a year over year rent growth of about 8% or so, which is absolutely insane. 7.8% to be more precise. And you can see San Jose, California was second, Northwest Arkansas, Rochester, New York, and Chicago, Illinois, which is where we actually purchase our buildings. So it's great to see. And that's hitting a 4% year over year rent growth, which is very, very strong. And you'll see a very interesting trend in terms of rent growth. If you haven't realized, a lot of the cities here are either the Northeast or Midwest, and those are the ones that are really, really seeing some very strong year over year rent growth instead of the South or the West, with exemptions of course, San Francisco, San Jose, and a few other cities here or there. But majority of these cities that are seeing some really strong growth are the Midwest and Northeast markets. And one of the big reasons for that is because they were quite supply constrained. And you'll see how stable the market has been, but we'll go into that a little bit further here. So let's dive into the vacancy rates of Q3 2025. You can see here in the US, across the board, it was around 9% in Q3 of 2024. So the same as last year. In Q4 2024, it ticked up to 9.2%, then down to 9.1%, then 9%, and now stable at 9% vacancies for Q3 of 2025. So as you can see here, the South and West have higher vacancy rates compared to the Northeast and Midwest. And across the board throughout this data, you'll see that the Midwest and Northeast remains quite stable or beats the national average in many of these key areas. So for example, in a market that we're in Chicago especially, has very low vacancy rates. So as you can see here, 5.8% in Q3 2024. In Q3 of 2025, we're now looking at 4.7% vacancy rates, which is one of the lowest in the country, as you can see here with all the other comparisons. Just to compare, for example, Miami, Florida, where I reside, the vacancy rates are 9.1%. And one of the ways that they're looking to combat this is by giving rent concessions, maybe 1, 2, or 3 months of free rent for the residents. And that way they can keep their rent amount high and their rent rolls, but still be able able to get those higher occupancy levels. So that's what they're doing there. And if you look at other places in Texas, for example, Houston, Texas, which is a very hot market, you can see that the vacancy rates are hitting 11.6% in Houston. You can see in Austin, you can see it's sitting at 14% vacancy rates, which is incredibly high. But compared to last year, it has gone down. And even looking at Durham, North Carolina, which I know a lot of fund managers and institutions have gone to, the vacancy rates are above 10%. Now let's look at the asking rents Q3 of 2025. In the US, you can see that the average rents that the US is asking for as of Q3 is $1,900. And the Northeast is the most expensive by far, $2,725 on average. The Midwest is the lowest by far at $1,506. The South is next at $1,637, and then the West $2,172 as of Q3 2025. And this is one of the reasons why I believe the Midwest is severely undervalued, just because you can see here the South is where a lot of the institutions have gone, but the rent amount is quite similar to what the Midwest is. But the values of the properties are way cheaper in the Midwest and way more affordable. Again, just comparing it with Chicago, just because Chicago is a market that we're in. In Q3 of 2025, you can see rents have steadily increased year over year, quarter over quarter, 1943, all the way up to 2024. Now, what we saw in some of the Sunbelt regions in the South is the opposite. So you can see here, for example, Austin, 1591 in Q3 of 2024. Now they're seeing rents at 1546. So it's actually gone down since last year, and that trend has continued on quarter after quarter. And let's take a look at Miami. So Miami has gone up since last year, about $40 or so. San Antonio, Texas, relatively the same as last year, just slightly down $10 less than what it was at Q3 of last year. And this is always interesting to see. And you can see other Midwestern markets have gone up. Toledo, Ohio, for example, 1,007 to 1,042. Not a big jump, but you can see there has been a jump nevertheless. Minneapolis, 1,587, 1,633. Madison, Wisconsin, 1,595, 1,648. Now, that doesn't mean that it's going to continue happening, but just because the Midwest is that much cheaper compared to other parts of the U.S., I do believe that the only way that it can go up is up, especially with inflation. Now let's take a look at inventory. So one of the reasons why the rent growth is quite stable and strong in these Midwestern cities, especially a city like Chicago, is because of the fact that supply is restricted. So you can see that the inventory that exists in the Northeast is around 2 million, in the Midwest around 2 million as well. In the West, it's a little bit higher at 3 million. In the South, there's tons more at 6 million. And you can see there's way more deliveries for inventory in the South, whereas the Midwest and Northeast, not so much, just because it's very difficult in a lot of these cities. Like, for example, Chicago, permitting is very difficult to get and it's very difficult to build as well. And so therefore, there's just not as many projects going on. Whereas the South, it is a little bit easier to get those approvals and permitting to go and complete these construction projects. And with the supply being so much more constricted, it just means that the rent growth is going to be a little bit more stable than in other markets where you saw some volatility in the last 5 or so years. But this is pretty much the high-level overview of this 2025 Q3 report. It doesn't mean that the Sunbelt region or the South or the West is an area that you should 100% avoid. This is just what the data shows as of right now in Q3 of 2025. And this is one of the reasons why, though, we are super bullish in the Midwestern markets, because it is supply constricted in many of these cities, especially Chicago. And you can see that the rent is severely under market rent compared to the national average. And we believe that the only way that it could go is up from there. And the vacancy rates, again, are very, very strong and much lower than all the other counterparts. So that's the data for Q3 2025. I'll go ahead and do another video like this when Q4 2025 reports come out. Hopefully you enjoy this video as much as I did. I love going through data like this. And so we'll go ahead and see what happens in the future. No one has a crystal ball, but at least we get the sentiment on where the markets may go. Hopefully you enjoyed this video. I'll see you on the next one. Thank you for watching.